Hello, folks. Brandon Chapman with you today. It's another video for TheoTrade for Thursday, February 16, 2023. Boy, we came full circle. The rally fades as the backdrop of inflation and volatility risk kind of reemerges here. You notice kind of where we kind of finished yesterday afternoon. We held pretty much overnight. Inflation, specifically PPI data, came out hotter than expected. The month-over-month print was 0.7. On the headline. And again, we just saw the market just begin to melt. And again, what does this indicate? The Fed is poised to continue to raise rates. The inflation fight's not over. And then all of a sudden, about a half hour after the cash open, we see the ES rally, the S&P 500 futures rally, basically making back virtually all of the losses from the overnight session, making it back very close to the previous day's close. And then the last hour happened, and we saw order restored as we traded near the lows of the session finally. And again, it begs the question, what is the market thinking right now, right? I mean, what is going to cause the market to see the next down leg? And again, what kind of special considerations should we make for volatility, specifically 0 days to expiration option volumes that have exploded recently? So we're going to kind of address that in our video today, as well as look at CSCO, CVS, Nutrient, and a couple of precious metal stock, gold and silver, to see, are we starting to build a case for gold or not? But again, you'll see we're trading lows of the session in ES today. If we look at the VIX popped a little bit here. I mean, it wasn't a massive spike. Of course, the S&P was only down 1.38%. If we look at GLD, gold was actually flat on this session. If you look at the dollar index, we'll choose UUP as a proxy. The dollar was modestly stronger. So yesterday, after the market was up a bit, despite the rise in the dollar, today we saw the market decline on really a flat dollar, which was not really putting any bearish pressure on the broader market. And yet we finished down on the session rather sharply. And the VIX didn't move a tremendous amount, finishing right around 20. So the question here is, where are we going next? As we look at the market currently, we're still trapped in this kind of this range that we've been in now for a couple of weeks off of the high on February 2nd. I thought yesterday, after we saw that kind of neutral day on Tuesday, again, very evenly balanced market in terms of volumes and up, advancing, declining stocks. Yesterday, we kind of finished near the highs of the session on a stronger dollar. And man, it just looked like we're poised to start to make a move, but the reality begins to set in. However, I'm not sure this is really the beginning of a major sell-off. It is a very real possibility we could sell off to next levels, which would be 4,000 and then maybe 3,900. And all that does is maybe reset the high point. So previously I was thinking we could have one of two scenarios. Either we break out here, and I kind of laid this in my session, we might go 4,300 and we start to reach that kind of peak realization in the market, or we sell off towards 4,000 and 3,900 and then catch the rally back to around this kind of 4,000, 4,100 level, and we set up at that point. So I'm not sure which direction we're going to take. The one thing that just seems for certain is that we are not poised to go substantially higher right now in the market. That at this moment, the upside's relatively limited relative to the downside. And this downside is only relatively short term, maybe a month or two, right? Maybe we squeeze out a little bit more there, or we start to see and we trip to the downside. We're watching the SKU index to see if hedging activity is really pointing to that. And the reality is, this is where we closed yesterday, about 121. It's not. When you look at the 3-month VIX relative to the 1-month VIX, we're looking at term structure. We dipped today at 1.08. What we're seeing is that the volatility-based metrics that are based on the VIX, that 30-day window, are not pointing to a major sell-off right now. Now, some people are looking at this saying, yeah, but what? Well, yeah, but the market, we're seeing volumes on 0 days to expiration options exploding right now. And that's where the real story is. And therefore the VIX is irrelevant. And look at this today, right? I mean, 450,000 contracts traded at the 412 strike for February. This is huge on huge, right? Massive, massive volumes. And some people are saying, look, these are sellers and we could see vol really explode. Well, you know what? I'm not so certain about that. The fact of the matter is these are not great hedges because why? They just expired. They're not really carrying overnight. So the fact of the matter is that I would characterize the market right now and look at the volumes for March out here, 29 days. That's kind of fitting that 30-day window. Are we seeing increased volume out here? Not a lot, right? We're not seeing the tens of thousands of contracts traded around the 30-day window. This is the SPY, it's not even the SPX. So the point is that right now what we're seeing is there's not a strong desire to hedge. And that's the bigger difference. There is, from my perspective, there's probably a lot of buyers in here trying to create that kind of gamma squeeze environment that could propel price. And in fact, just to give you an example today, so on Monday, I outlined several different call option activity in a number of stocks. One was Run. Run, made a big jump yesterday. QuantumScape is one we looked at yesterday, but this occurred kind of concurrent. You see the massive, massive move here, right? The option volatility, the option volumes rather, the area that it traded, tricked the trigger at around $10 and created this squeeze higher in QuantumScape, right? And we started to break 10 right here. What happened? Started to see that gamma squeeze and that explosion in the last few minutes before the close. That's what we call a gamma squeeze, folks. That's not caused by option sellers, right? These are option buyers in there, and it creates its own momentum, right? By virtue of this positive feedback loop. On Tuesday, Silvergate, strong volumes coming in on Tuesday in Silvergate at the 16 strike. We started to kind of break that here. We saw a big pop yesterday. This is a trade outlined on Tuesday during my session. And now what are we seeing? We're seeing a reverse today, right? Which normally happens. You get the big short squeeze and then it reverses. So when we get these kinds of scenarios, what happens, right? You see the option volumes help create the environment that can see big moves. Like Jumia, for example, yesterday, Feb 4, we kind of popped above 4 and we dropped again today. So a lot of these high short interest stocks really sold off hard. And all you got to do is look right here, cyclicals and technology and communications. When you look at the high beta names, the S&P 500, it is defined by those three sectors for the most part. 3 of the top 4, in fact, cyclicals and technology were the top holdings in the fund SPHB, okay? And so again, this has been kind of a theme, looking for bullish opportunity in those areas. But today, you really saw the air come out of the short squeeze part of the market. And those were the most down stocks on today, technology and cyclicals. Top here, staples, utilities, still down. Why? Well, guess what? I mean, they're not exactly underpriced stocks, but they did hold up relatively better on a down day, representing more the defensive part of the market. And so when we think about, again, all this talk about 0 days to expiration and saying that the VIX is irrelevant, the VIX will become relevant when we start to see hedging activity pick up. And that's why we look at SKU. And SKU, the last month, it's done nothing, right? We're hovering around 120, 121. This is not a high level. We're not seeing any mobility on the SKU front. And so as a function, when that occurs, that's the sign, right? When this starts to get up here around 130 or north of 127 or higher, this is where all of a sudden we're starting to look at it and say, boy, the market's starting to price in the downside risk in the market. But as of right now, the fact of the matter is a lot of these sell-offs are going to be bought, okay? And so as a function, today may not be the indication the market's really going to fall apart. But it may pull back to 4,000, maybe 3,900. But a lot of these rallies have been, a lot of these selling days have been bought back up again. And I think we may continue to see this, but maybe we grind it out to 4,000, we grind it out to 3,900. This does reset maybe a near-term opportunity back up to highs again, but we've yet to see these volatility-based indicators really point to a major correction like they did, for example, back here in early December, back here in August, on August 12th, back here at the April high, back there in December, okay? When these climb the hill and they start to point to downside, it's when the hedges start to be implemented. And right now, there's no hedges, which says they're okay with the downside. They're okay with the upside right now until they're not, until that changes. And so as a function, again, we may grind it out to the upside. We may fall a little bit and then grind it out to the downside. Just realize there's not a real strong directional component. We're long in the tooth in this rally. We're just looking for the hedgers to return and start to buy that back month premium, or start to buy puts and sell calls to help offset. That really is starting to point to corrections like we saw in August, corrections like we saw in March. This was even over a 5% pullback right here, but normally those indications skew to 130, the 3-month VIX being 20% higher than the spot VIX. That points to a 5 to 10% correction. Again, if it's a 20% you're looking at, you're probably reallocating a little bit, but you could certainly continue and progress towards a 20% pullback. But again, those type of measures, generally 5 to 10% is what you're expecting, something you could hedge against or at least start to take profits into. So I'm not really looking at this as being bearish right now, but near term, we could see a little bit of pullback. We are seeing further resistance at that high. We're yet to take out the lows. If we do, then we start to march back towards 4,000 or 39 here. Those will be the next kind of key levels in the market. And then we'll see how the volatility measures stack up. If we start to see that the 3-month VIX is less than, this starts to drop down here below 1, that's a bullish indication, right? So for example, early March, late April, here early June, right? September, October, and here, this was a very strong bullish signal. We got both skew down close to 115, also seeing the 3-month below the 1-month. This was a strong kind of buy signal that the market was going to reverse until we eventually climbed the hill in early December. But then we kind of languished here, began to break out early this year. And so right now we're just hovering at the moment. And there's not really any strong bullish or bearish indication, which means the market, generally speaking, will tend to glide higher, and selling days are generally bought. So I'm expecting that unless we break support, then we'll look at the market maybe rolling down to the next level, but not necessarily aggressively. Okay, so we'll see how this plays out. But the PPI side of it, we are seeing interest rate expectations really change. And we're all of a sudden now starting to price in 5.25, 5.5, which obviously is going to place pressure on treasury bonds. The 10-year up at 3.8% today. You look at the 3-month T-bill at the moment, it's 4.665. This is going to continue to rise north of 5% until the Fed looks like they've reached kind of their peak level on the Fed funds rate. So we're going to get a dot plot in March, and they're meeting there to give us more of an outlook. But right now we're starting to price in 5.25, 5.5%, which means that treasuries are going to continue to sell. This will eventually feed back into stocks as borrowing costs are high. That reduces profitability and margins. Now, a couple of stocks that experienced earnings today. One was CSCO, and this is one that an option trade I outlined on Monday that came in. It was a 53 strike up here for the March 3rd expiration, and kind of pointing to the fact the earnings may be relatively positive. And the fact of the matter, they were. Not only did they beat revenue, they beat earnings, EPS, they raised guidance, a lot of positive dynamics. They raised their dividend 3%. So the idea is that, this isn't a high yielding stock at 2.98%, but getting a 3% yield is not a bad situation. This stock has very strong free cash flows, et cetera. But, again, worried about a market correction. Obviously, this being a technology stock, it would be very reasonable for this to sell off with the broader market. If we have this window here, again, we could see CSCO maybe get to 55 to maybe 58 up here. That would be the expectation in the coming weeks. Now, if you're a little afraid, we did fade from the high today. We may see the market roll over. You could certainly look for it to test the support level, which is the low of the gap day there at about 49.79. That goes back to historical support as well. You could also look at, the fact that you might be getting a 39-cent dividend with the adjustment. When you start to look at, the trade tab in here, could you buy some protection? Well, look, you could potentially take, even if you're like targeting the underside here at 56, right? You could potentially say, look, in the next 30 days, you could use that premium. This has gone up a little bit from where I was earlier in my session today. buy a $50 strike price, or you can get into the weeklies here and get more granular. Use that to buy a 48. So now all of a sudden you're risking $3 to make, maybe, $6 to $8 or $5 to $7. That gets you in the ballpark here, and you've capped your risk at 48. So if we drop suddenly, we start to go in the money. Again, this does present some opportunity. That is just a synthetic call, by the way. And you could look even at a call spread. The volatility is not as advantageous for doing call spreads here. So we're looking at buying the stock and using the dividend to finance a put as a protection. So anyway, just some ideas as to how to play some of these moves. With that 3% yield, you can kind of let this stock do what it wants, right? If you're looking at a bigger target, going back to the highs back here at 65, you could let this stock fluctuate a bit, buy some protection in the near term, buy a downside put spread, that sort of thing to help reduce the risk. But you got that 3% yield in lieu of a run to 60, 65, in which case you sell it. Okay. Just some ideas there. Another one that's interesting and turning around right now is Nutrien. This is one that there was option activity in today. It was a roll to the 85 strike. The earnings, however, in Nutrien were not exactly great. What you saw was reduced guidance. We saw the company miss earnings and basically come out in line on revenues. But last year was a banner year in 2022. And right now the projections for 2023 are substantially higher than what they achieved in 2021. So we are seeing a trajectory that looks decent. The company's maybe a little bit undervalued at this level. And so today's movement, we did fade from the high here. If we start to see a strong planting season, again, the outlook is better than 2021, not as good as 2022. Again, it still creates an opportunity for this stock to move and be profitable. And as we look at the yield here, it's about 2.5%. They are raising their dividend from 48 to 53 cents. So again, you're collecting some money. You could buy some put protection, looking at an upside target of 91 to about 95 up here. So again, bobs around, you collect the dividend. If we get the run, you look to take profits into strength. So again, some interesting kind of play there. And again, the 85 strike was rolled to today. So again, it gives us some near-term target of 85 with the ability to stretch towards 95. And again, you could take the dividend, 43 cents, 36 days out. Let's go to Nutrien March in here. I mean, could you get like a $70 strike price? Might cost you a little bit extra, but you're able to cap your losses at 70 down here. So again, just if you're concerned about the near-term potential, again, you're getting that yield plus the potential upside here on a stock that's relatively undervalued. You're just looking for valuations to normalize to the upside. CVS. CVS is one that, again, I mean, CVS. There we go. CVS is one inch. We're grinding it out the lows. We had a nice breakout last week. The stock's pulling back again to support, hanging on here a bit. The dividend yield's about 2.75%, but this is more about valuation plus a dividend. So if we're uncertain about the market, again, I think, do we start to emphasize utilities and staples, or at least dividends and undervalued, relatively undervalued stocks? I think that's potential to play here. Looking at about a 94.50 target. Again, this one that's on Friday, there was some bullish activity at the 92 strike. So point being is that look for a close above today's high as an indication of a bounce. Looking at a swing towards about that 94, 95 level. I'm on the stock. You could do a spread as well as to take advantage of that opportunity. Finally, we're going to look at AU and Hecla. So this is Anglo Gold Ashanti. Gold, as we've talked about, again, I've been on this kind of bullish bent since this day right here. We kind of took it off, put it back on, took it off again. This seasonal trade generally ends around mid-January to February. It's exactly what happened here of late. I think there are risks for the dollar to rise, which would put pressure on gold and gold stocks. But today in AU, you saw it in AU and Hecla. Pan American Silver. Sorry about that. Hecla was on, what day was it? Hecla was on Monday. Wrote down this wrong symbol here, but today it was Pan American Silver, PAS. They all look pretty similar here. Again, this is all based on what? The idea that if the dollar starts to weaken here in the near term, we might see some strength in silver, in gold stocks. And it doesn't mean we're going to new highs in GLD or new highs in SLV. We might just get back and retest the high of the gap day here, for example, in silver. But this can create some decent movement in these companies, getting back to just off of prior highs. So again, I think it is something to watch for. Do we start to trade through this tomorrow? Obviously, prices are high for them to still generate decent profitability. So I think, starting to watch for a near-term rally if the dollar starts to pull back here. And of course, this is a catalyst for the stock market breaking out to the upside and reaching its near-term extreme. But we may have to get the next move, the next rally in the market on the back of a weaker dollar to push it to 43 instead of pushing it to 39. So watch it. If the dollar starts to weaken, look at gold and silver as a proxy. You could look at UP. It's not as good of a proxy, but it's there. If this starts to break down, again, look at Anglo Gold, Ashanti, Hecla. These are three that have seen significant option activity this week. And again, are they early? Yes, they are. So look for a little bit of a reversal. Look for a weaker dollar and for the market moving higher. So this is one area to watch right now. A lot of these leading into earnings here, but I think it is interesting. We're starting to see more bullish option activity come into these names. Anyway, folks, that's today's video. We'll catch you back next Thursday. This is Brandon chatting with you today. You have a great one. Thank you.